It is a pretty rare combination to have a company that can provide a low beta yet grow free cash flow per share by double digits over the last 15-year time frame. And if you were to look at the price of this stock over the last, any sort of time frame, 1, 3, 5, 7, 10-year time period, it has been a consistent outperformer of the S&P 500 up until the recent slide it's gone through, which has caused it to underperform a bit over the last 3-4 months. The company I'm going to talk about today is Waste Connections, and this is a garbage disposal company that's kind of getting a lot of attention right now because it's went on one of its larger drawdowns over the last half decade here since April. I'm going to get into the bull case, the bear case, and my overall thoughts. I'm going to try to get that inside 5 minutes. And if you've been looking to add this outstanding company to your portfolio, this is going to be a video you want to watch. And as always, everybody, there is that free report in the description on my top 4 holdings, my allocations, my thesis, my risks, and you can grab that for free. Just takes a few seconds down in the description, but let's get right into the video. So what exactly is Waste Connections? Well, it's kind of obvious by the name. They are a garbage collection company. It controls about 9% of the US market, which is relatively low when we compare it to one of its major competitors, Waste Management, but it is also a Canadian traded ticker that really does not have that much exposure to Canada. So don't get the impression if you buy Waste Connections, you are buying some Canadian waste disposal company. They have around 85% exposure to the United States and only around 15% to Canada. Now, Waste Connections operates in a very fragmented industry. There are a lot of smaller garbage disposal companies, so the company does take a very aggressive approach building through acquisitions. It makes around $300 to $500 million in acquisitions every single year, which continually adds to the company's revenue and free cash flow. Now, the bull case is that the vast majority of waste collection is immune to economic slumps. It does not matter whether you just got a promotion or whether you just got laid off. Every single garbage day, you're going to haul your garbage out to the curb, and a company like Waste Connections is going to come pick it up. These are typically contracts signed with the municipalities of whatever town or area you're in, and there is relatively little competition in terms of these specific municipalities because Waste Collections also owns the landfills. So even if competitors are utilizing the landfills in that area, there will be costs for them, added costs for them to actually utilize those landfills. It creates a pretty solid economic moat, and it creates a particular section of the business, that being, say, commercial waste disposal, residential waste disposal, things like that, that provide very, very predictable cash flows, revenue, earnings, free cash flow, things like that, because regardless of the economic circumstances, you need this service. It needs to be provided. A second bull case I'll talk about, and one I had talked about previously, is that low beta. Waste Connections only has a beta of around 0.5. So it is low volatility, but that is also combined with double-digit growth. We have a 10-year compound annual growth rate on free cash flow per share of 10.5%. This dual combo here is quite a rare combination. Often when you have companies that are growing at a double-digit pace, they tend to be valued higher, they tend to be more volatile in terms of overall share price. Now, the third bull case, and this is probably the most important one you're going to want to pay attention to, is pricing power. Because of the economic moat, because of the dominance of these waste collection companies, they tend to have extensive pricing power. Now, if we look to the company's core pricing, we can see that it's been able to grow that pricing at a mid to high single-digit pace throughout the entirety over the last 5 years. And you could extend this out to well before 2019. This core pricing growth allows it to continue to grow revenue and earnings regardless of what the economy is doing. Because right now we have declining volumes. If you look to this chart here, you can see that their volumes are declining, but they've been able to more than offset the decline in volumes with an increase in price. Not only are they able to increase the prices to offset the volumes, but they've also been able to increase prices to the point where it's more than offsetting the inflationary costs of actually running the business. Now, the fourth bull case is that acquisition strategy. The company deploys $300 to $500 million a year towards acquisitions so that they can continually grow revenue and free cash flow. The area is heavily fragmented, which allows them to buy numerous small players in smaller regions where there's not a lot of competition. And although this acquisition strategy does weigh on the company's returns on invested capital, it is ultimately one that has done very, very well over the last while. So the bear case, one of the main bear cases for this company is definitely valuation. I would argue that this company is priced to perfection right now, primarily because throughout all this economic uncertainty, investors have flocked to defensive type stocks like Waste Connections, ones that can grow revenue, earnings, free cash flow regardless of the economic circumstances. And as a result, the company was very expensive. At one point, it did get up to 40x expected earnings. Now, we're sitting at 32x expected earnings right now, which is still more expensive than you would have paid for the company in the past. And it does need to continue to execute right now to justify that valuation. And the interesting thing here is now that the markets have turned super bullish since April, we're starting to see a company like Waste Connections go through a double-digit drawdown as there is more outflows from these defensive-style companies and into more high-growth companies. So although it's more attractive than it was, it's still very expensive and it does need to execute to justify this. Now, the second bear case would be the economic cycles. Now, I did mention in the bull case that the company was immune to this, but that would only be the segments of the business like residential waste collection, residential recycling, commercial, things like that. It still does have a lot of exposure to the construction industry, which is very sluggish right now. The company said it is definitely dragging on its results, and it also does have a lot of exposure to energy companies. We're talking commodity recycling, all that type of stuff, which is also down by 15% in its United States segment. So although we can see these segments picking up when interest rates decline, when economic activity picks back up, there's no doubt they're weighing on the business right now. And this is the one portion of the business that is definitely exposed to the volatility in the economy. Now, the third is debt levels. So because Waste Connections takes on such an aggressive acquisition strategy, debt levels are high. Now, debt to equity is relatively healthy at 0.99. It's actually much healthier than a company like Waste Management, which sits at nearly 3. However, the company does have interest coverage ratios of only 3.5x. So this would be the amount of EBITDA the company generates relative to the amount of interest expenses it owes. Now, this is a very low ratio. Typically, you do want to see higher than this. However, there is an element that the company's cash flows are so predictable because of the segments it operates in that it's likely able to manage much tighter interest coverage ratios because it has a very good idea as to how much money is going to be coming in. You'll see this with a lot of utilities that typically run tighter interest coverage ratios because, the regulated utilities are going to bring that capital in regardless. So although the ratios are perfectly fine at 3.5x, they are tighter and the company will need to continue to execute on its acquisition strategy because ultimately if it buys poor companies, takes on debt to buy these companies, those interest costs will drag, which will ultimately hit earnings. So overall, I really like this company. It does provide a nice blend of low beta exposure, low volatility, but double-digit returns. The only difficulty is when you get a company that does this and they do this so well for so long, valuations are going to be high. So if you are a stickler for valuations, you're probably not going to like Waste Connections here, trading at 32x expected earnings. The company needs to continue to execute like it has in the past in order to drive strong returns. Now, the double-digit drawdown in its share price has definitely put it on my radar. I have been debating pulling the trigger on this company over the last while, and I would imagine this double-digit slide in share price is also why a lot of watchers requested me to go over this company. Because of the valuations, the heightened valuations, I wouldn't necessarily call it a slam dunk buy, but I am still a very big fan of this company. It has a market cap of around $66 billion, which is around half of its major competitor, Waste Management. So there is definitely more room to grow here. The company has plenty of runway, even though it is a relatively large Canadian company by standards. I think if you wanted to buy this company today, I would have no objections outside of the fact that it is trading at a premium, but I still I don't think you can go wrong with a defensive company like this that has such a high amount of pricing power and also just sticky contracts with municipalities. That residential waste, that commercial waste, it's always going to stick around. It's always going to provide steady cash flows. And ultimately, the acquisition strategy of what the company has done so well over the last while is what is going to propel it even further in terms of growth. So everybody, that's it for the video. Head down below, like the video, subscribe to the channel, comment, let me know what company you want me to go over next. And do not forget your free report in the description on my 4 top holdings, my allocations, what I think of them, the major risks associated with holding them, plus a ton of other stuff. Absolutely free, just takes a few seconds. And we'll see you next time for more great Canadian content.